A short quiz to test our understanding of reissue and forfeiture. Balance in the shares forfeiture account in balance sheet under. The balance in the shares forfeiture account is shown in the balance sheet under A. Share capital account, B. Reserves and surplus account, C. Current liabilities, and D. Provisions. The correct answer is share capital account. Shares forfeited balance, shares forfeited account is added to the amount of share capital. Correct answer A. If forfeited shares which were originally issued at a discount are reissued at a premium, the amount of such premium will be credited to A. Share forfeiture account, B. Securities premium account, C. Capital reserve account, D. Discount on issue of shares account. If forfeited shares originally issued at a discount are reissued at a premium, the amount of premium will be credited to securities premium account. Answer is B. Shares when they are issued at a premium, whether it is reissue or original issue, the amount is retained in the securities premium account and it cannot be used for any other purpose except the four purposes, which is issue of bonus shares, writing off of preliminary expenses, writing off of commission or discount, or any other expense on issue of shares or debentures, and it can be used to set off the premium on redemption of preference shares or debentures. So the correct answer here is B. Next, discount allowed on reissue of forfeited shares is debited to. Discount allowed on reissue of forfeited shares is debited to general reserve A, B. Capital reserve, C. Revaluation reserve, D. None of the above. The discount allowed on reissue of forfeited shares is actually debited to shares forfeited account. Is debited to shares forfeited account. Therefore, the correct answer should be D. None of the above. It is not debited to general reserve, not debited to capital reserve, not debited to revaluation reserve. Therefore, the correct answer is D. None of the above. Next, the directors of a company forfeited 1000 shares of rupees 10 each, rupees 7.50 paid up for non-payment of the final call money of rupees 2.50 per share. 700 of these shares are reissued at rupees 7 per share. The amount transferred to capital reserve account would be A. 2,500, B. Rupees 3,150, C. 3,500, and D. 5,400. Final call money, so it's a fully called up share. 700 of these shares are reissued at rupees 7 per share. What is the amount to be transferred to capital reserve? Now, what was the profit which was made? The profit which was made is 2.50 is not paid. Therefore, 7.50 is paid. Therefore, 7.50 per share is the profit made. 700 of these shares are reissued at rupees 7 per share. That means the discount or the loss is actually 3 per share. So, profit is 7.50 per share on forfeiture. The loss is 3 per share on reissue. So, what is the net gain? 7.5 minus 3, 4.50 per share is the net gain. How many shares were reissued? 700 shares were reissued. Therefore, what is the net gain? $3,150 should be the net gain. The correct answer should be B. 3,150. A company forfeited 100 equity shares of rupees 100 each at a premium of 50% to be paid at the time of allotment, on which the first call money of rupees 30 per share was not received and final call of rupees 20 is yet to be made. These shares were subsequently reissued at rupees 70 per share, rupees 80 paid up. The amount credited to capital reserve is A 4,000, B 2,000, C 3,000, D none of the above. What was the profit which is made on forfeiture? Profit on forfeiture. First call money of rupees 30 per share was not received. The final call of 20 is not made. This accounts for 50. So final call is not made, 20, 30. Remaining 50, therefore, we can assume was received. Remaining 50 was received. This includes the share premium, securities premium. But if securities premium is received, we cannot use it for anything else. So the profit which we have made, we consider only 50 rupees of the called up value. 100 rupee share, 100 rupee share of which 20 call not made, only 80 is called up, out of which 30 is in arrears, was not received, therefore 50 was received. This is excluding the premium, taking only the face value. So profit on forfeiture is 50. Next, these shares were subsequently reissued at rupees 70 per share at 80 paid up. That means the value is shown as 80, but the shares were issued for 70. Therefore, the discount element here is 10. So, what is the loss on reissue? Is rupees 10 per share. Therefore, the net gain is rupees 40 per share. How many shares were reissued? All the shares were reissued. Therefore, 40 into 100, 4,000 should be transferred to capital reserve. The answer should be A. Once more, the company forfeited 100 equity shares of rupees 100 each. This was issued at a premium of 50%. Actually, it is 100 plus 50, 150. The first call money of 30 per share was not received. This is not received. It's in arrears. Final call of 20 is not made, not called. So what is the called up value? It is only 80. Out of this 80, 30 is not received. Therefore, it's assumed that the 50 is received. Mind you, we have received this 50 plus the 50 premium. But if securities premium is received, we cannot disturb the securities premium account. The whole treatment is as if there is no premium. We just ignore the premium element. So what is the gain that we have made on forfeiture? The gain is rupees 50, the amount which is received. What is the loss that we are making? The loss is actually 10 rupees here. Why is it 10 rupees? Because they are subsequently reissued at 70. We got only 70, but the share is rupees 80 paid up. It's not yet a fully paid up share. The remaining 20 will be collected from the shareholder later. So the discount element here is only 10. Therefore, the net gain per share is 40. We are talking of 100 shares. It is 4,000. Alternatively, since all the shares have been reissued, we can frame the entry, check what is the balance in the shares forfeited account and transfer the entire balance in the shares forfeited account to the capital reserve, because there should be no balance left in the shares forfeited account since all the shares which were forfeited have been reissued. Therefore, correct answer is 4,000. B Limited has issued its shares of rupees 10 each at a discount of rupees 2 per share. Ram, holding 100 shares, could not pay the final call of rupees 5 per share. His shares were forfeited. Later on, the company decided to reissue these shares. What is the maximum amount of loss per share on such reissue could be? A. Rupees 5, B rupees 2, C rupees 7 and D rupees 13. Final call was made. It's a fully called up share. You're talking of a rupees 10 share. Final call in arrears is rupees 5. Okay. There is a discount of rupees 2. Therefore, the amount which must have been paid, the forfeited amount, should logically be 3, accounting for the full 10. 5 in arrears, 2 is discount, therefore 3 must have been paid. So this is our net gain. Next is what? The company decides to reissue these shares, and what is the maximum amount of loss per share on such reissue? Now, strictly speaking, the loss, the discount, if when shares are reissued, the discount, maximum discount that can be allowed is the amount that we have forfeited, which is in this case is rupees 3. However, the small exception here is rupees 3 plus, since these shares were originally issued at a discount, plus 2, the reissue can be made at a discount of rupees 5. If you note, the accounting entry on reissue would be bank account debit. The accounting entry on reissue would be bank account debit with the amount received. In this case, if we take 5, discount account debit with the original discount of 2 per share. So, shares forfeited account would be debited with only 3 rupees to share capital is 10. Therefore, shares forfeited account was credited with 3, it is debited with 3. This would be the maximum amount of loss. Therefore, the total discount which the company can issue could be the 3 plus 2 original discount, rupees 5. Correct answer A, rupees 5.